Yeah, you really have to go back to June when this began, and it really coincided with the time when the tariff issue with China started to take hold of the market. And so since June, we've seen defensive sectors lead pretty much across the board, and cyclical sectors have really underperformed. We got a little bit more negative on tech specifically in the middle part of July, just recognizing that this was one of the few cyclical sectors that had not really taken its turn at the wheel and being derated like these other sectors. So what's behind it is, we think, a peak in growth. We think the second quarter will prove to be the peak in growth rates for the US and probably global growth. At the same time, we're seeing a continued tightening of financial conditions, which is weighing on valuations, which has been going on all year, really around the world. And I would just finish up by saying there's really only two sectors in the US that have not derated this year. One is tech, and the other is consumer discretionary, which is really being driven by the three tech names within that of Amazon, Netflix, and Booking Holdings. So it's really a tech story, and that's where the risk is, because those stocks have not derated yet. The good news is that process is beginning, I think, over the last month.
And Joe, it's interesting because the market is telling that story seemingly, while we also have 4% growth, at least in the second quarter. We had a very good jobs report on Friday, and the Fed seems to take some confidence in that, and it's going to respond accordingly.
Right. They should. Growth actually in Q3 may be better than 4.2. And the good news is, given the slowdown in employment, if you get 4% plus growth, that's the second quarter in a row in which productivity was up. The data look great. The problem is the Fed, or what I think is the problem will be the Fed, and that is they continue to raise rates in response to a healthy economy, thinking the yield curve doesn't matter when in reality it does. If you think a recession, though, is still a couple years away, the stock market still is, has not hit its cyclical peak. It still has, or its all-time peak, right? It's still going to go up a lot more.
How do you factor in another round of tariffs on China? And if the Chinese choose to retaliate, they've got to do it through qualitative measures. They don't have enough to do dollar-for-dollar tariffs.
Look, China, to me, is going to lose this battle, if you want to call it that. I mean, that's why they've now backed away twice in the past 6 weeks and undertaken more stimulus, because their economy is slowing. To me, the tariff stuff is important. It's mostly political. It's a negotiation. Melissa, this isn't going to kill the business cycle. I mean, this has been out for a while, and I would argue that the biggest pullback we had in markets earlier this year was around the worries of inflation and Fed tightening. The tariff concerns came later, so I think it's important, but this isn't a game changer in my mind.
Hey, Mike, you did a great piece last week where you say, essentially, although you're calling for some consolidation in stocks, you argue we're at the beginning of this new era of data in which things like autonomy and the Internet of Things is going to drive CapEx and productivity, at least for a limited universe of stocks. Can you sort of talk about how that can coexist with markets that, in your view, won't be performing as well in the future?
Yeah, really, this goes back to 2016. We started to write about this 2 years ago, that we were expecting a productivity boom long before the political stuff occurred in the last year and a half. And the idea was that companies have been underinvesting for a decade. That's what the QE era has kind of brought about, in fiscal austerity. And so that's happening now. And if you actually even look within the tech space, I mean, a lot of these market leaders are not technology companies. They've just spent money on technology wares to disintermediate existing businesses. And so the ones that are obvious are names like Google and Amazon and Facebook and Priceline, et cetera. Those have done a great job of investing in tech to create new business models. And our story for the longer term, which we think we're in a secular bull market, is based on this idea that the broader economy now, other industries are going to start to invest in tech more aggressively. And those are the real big fat pitch opportunities, we think, over the next 3 to 5 years, areas in healthcare and financials and even the industrial space.
Joe, how does that play into this idea that you think that the Fed is the main thing that matters here, and that the Fed can put the brakes on, never mind what corporate America is doing on the investment side?
I mean, that's always the case. I mean, the Fed has been a tailwind for most of this 9.5-year bull market, and now we've seen them raise short rates significantly. We're seeing pockets within the currency, the dollar EMFX has tightened dramatically, and the yield curve is inverting, and they're slowing the balance sheet. So to me, it's ultimately about liquidity in the Fed. And with unemployment where it is, my concern is typically the case is the Fed overreacts to an inflation threat that's not there. They hike too much and they slow things. There will be a recession almost invariably within 5 years. And as you know, Michael, when you have recessions, the median S&P drop is close to 30%. So there'll be opportunity at some point to buy stocks much cheaper. Of course, everything is always timing, and no one knows when that occurs.
Yeah, you don't know from what level the 30% drop happens.
That's right.
If it happens in 2 years.
That's correct. That's exactly right. Although historically, 2 years before recession, S&P with dividend returns is roughly 20% on average. So you get like one last blow-off rally.